A digital ticker flashes green, climbing higher and higher. The number represents a crypto investment you made months, maybe even years ago. It has soared beyond your wildest dreams, a testament to your foresight. But with this incredible gain comes a paralyzing question. Is this the top? Do you sell now and lock in these life-changing profits? Or do you hold on, hoping for even more, risking it all coming crashing down? This single moment of indecision is a crossroads every successful investor faces, a tightrope walk between greed and fear. What if there was a way to navigate this high-stakes dilemma without trying to perfectly time the market? Strategy that lets you secure your winnings methodically, reducing risk without completely walking away from future gains. This strategy exists, and it's called dollar cost averaging out, or DCA Out. You've likely heard of its more famous sibling, dollar cost averaging in, where you invest a fixed amount of money periodically to buy assets, smoothing out the bumps of market volatility. DCA Out is the mirror image of this concept. Instead of methodically buying, you are methodically selling. It's the disciplined art of selling a fixed amount of your assets at regular intervals to convert your paper gains into cold, hard cash. This approach is your secret weapon for realizing profits from a successful investment without the all-or-nothing gamble of trying to pinpoint the absolute peak of the market. It's about taking control, moving from a passive holder to an active manager of your own success. So, when exactly should you deploy this powerful technique? The answer isn't a single magic moment, but a series of strategic scenarios where a planned exit is far superior to an emotional one. The first, and perhaps most exhilarating scenario, is when you need to realize profits from an asset that has shown incredible appreciation. Imagine you bought a crypto coin when it was just a whisper on online forums. Now it's the talk of the town, and its value has skyrocketed, multiplying your initial investment many times over. Your portfolio balance is glowing, far exceeding what you ever anticipated. The temptation to cash it all out is immense, but so is the fear of missing out, the dreaded FOMO if it continues its meteoric rise. You're caught in a classic investor's paradox. You want to secure your profits, but you're not convinced the party is over. This is the perfect time to implement DCA Out. Instead of making a single, massive, and stress-inducing decision, you can devise a structured plan. For instance, you could decide to sell 10% of your total holdings of that coin every week, or perhaps every month. This systematic approach allows you to gradually convert your digital wealth into tangible cash. You can use this cash to diversify into safer investments, pay off debts, or even treat yourself to something you've always wanted. All the while, you still retain a significant portion of your original asset, giving you a continued stake in its potential future growth. You're not just taking profits, you're de-risking your success, one sale at a time. Another critical time to consider a DCA Out strategy is when the market begins to show signs of a potential reversal or a steep correction. You've ridden the bull market wave, and prices are at all-time highs. But now, you notice unsettling signals. The Relative Strength Index, RSI, a popular momentum indicator, has been in the overbought territory for an extended period, suggesting the asset is overvalued and due for a pullback. You might also observe that while prices are still inching upwards, the trading volume is steadily decreasing, a classic sign of waning momentum, like a rocket running out of fuel. Technical indicators that once screamed buy are now flashing amber warnings of a weakening trend. In this high-altitude environment, the fear of a sudden market crash can be overwhelming. Rather than trying to time your exit perfectly, an almost impossible feat, or panicking and selling everything at the first sign of red, DCA Out provides a rational, pre-planned course of action. By selling a portion of your assets periodically, you are essentially taking profits on the way up. This disciplined selling helps you lock in gains incrementally and significantly minimizes the potential for catastrophic losses if the market does indeed reverse sharply. You trade the anxiety of selling at the top for the peace of mind that comes from executing a well-thought-out plan, ensuring you don't give back all your hard-earned gains. DCA Out is also an indispensable tool for rebalancing your investment portfolio. Let's say when you first built your portfolio, you allocated 20% to a specific high-growth crypto asset. Over the course of a year, that asset performed exceptionally well, and its value has now grown so much that it represents 50% of your entire portfolio. While this growth is fantastic, it has also skewed your original risk allocation. Your portfolio is now heavily overexposed to the volatility of a single asset. A significant downturn in that one asset could now wipe out a much larger portion of your total net worth. This is where rebalancing comes in. To maintain your intended risk profile, you need to trim this bloated asset and reinvest the proceeds into other assets that are now underrepresented in your portfolio. Using a DCA out approach for this process is ideal. You can set a regular schedule, perhaps quarterly or annually, to review your portfolio's composition. When you find an asset has exceeded its target allocation by a certain threshold, you systematically sell off the excess. You then use the cash generated from these sales to buy more of the underperforming or lower proportion assets, bringing your portfolio back to its desired balance. This disciplined rebalancing ensures you are continuously selling high and buying low, a core tenet of successful long-term investing. Furthermore, the DCA out strategy is perfectly suited for when you need to withdraw a fixed amount of money to fund your financial plan. Investing isn't just about watching numbers grow on a screen. It's about achieving real-world goals. Perhaps you're saving for a down payment on a house in 3 years. It's planning for your child's college education, or creating a stable income stream for your retirement. These goals often require access to a specific amount of cash on a recurring basis. For instance, if you're retired and living off your investments, you need to generate a monthly income. Instead of selling a random chunk of assets whenever you need cash, a DCA out plan provides structure and predictability. You can set up a schedule to automatically sell a fixed value of assets, say $2,000 worth every month, to ensure you have the cash flow you need. This methodical withdrawal prevents you from having to sell a large position during a market downturn and helps you manage your finances with confidence, knowing that your investment portfolio is systematically funding your life's objectives. Finally, DCA out is the quintessential exit strategy when you decide you want to gradually reduce your overall investment position in a particular asset or even an entire market. Your life circumstances and investment philosophy can change over time. Perhaps your risk appetite has decreased as you get closer to retirement, or maybe your long-term conviction in a specific asset class, like cryptocurrency, has waned. You might decide it's time to reduce your exposure, but you don't want to liquidate your entire position in one go, which could trigger a significant tax event or cause you to miss out on one last potential rally. This is where a strategic phased withdrawal using DCA out becomes invaluable. You can create a plan to sell a certain percentage of your holdings every month or every quarter, methodically winding down your position over a period that you control. This allows for a smooth and orderly exit, reducing the emotional stress of a sudden departure and providing a more calculated way to transition your capital elsewhere, aligning your portfolio with your new financial goals and risk tolerance. Before you begin, however, there are several crucial points to consider. First and foremost, you must define your goal. Ask yourself, why am I selling? Is it to take profits, reduce risk, rebalance, or fund a specific goal? Clear objective is the foundation of a successful DCA out plan. So next, you need to calculate your selling rate. Decide on the specific percentage of your holdings or the fixed number of units you will sell during each cycle. This rate should be a direct reflection of your financial goals and your assessment of the current market conditions. The frequency of your sales, whether daily, weekly, or monthly, is another key decision. This will depend on the asset's volatility and how quickly you want to achieve your objective. Don't forget to consider taxes. Selling assets for a profit is often a taxable event, so be sure to understand the regulations in your jurisdiction to avoid any unpleasant surprises. Lastly, if your long-term belief in the asset remains strong, don't feel pressured to sell everything. DCA out can be used to simply trim your position, securing some profit while still maintaining a core holding for the long run. In the complex and often emotional world of investing, DCA out offers a beacon of discipline and control. It's a proactive strategy that empowers you to take profits, manage risk, and flexibly adjust your portfolio based on a plan, not on panic. By replacing emotional, all-or-nothing decisions with a structured, incremental approach, investors can navigate market peaks and personal financial needs with greater confidence and effectiveness. It transforms the daunting question of when do I sell from a paralyzing guess into a series of calm, calculated, and empowering actions.